Okay, I presume you all now know Nike. Recently, I saw the ad. I don't know if it is true or not. When they have these laces, kind of they tied it themselves, so kind of automated. I'm not sure if it was right or not, or just a joke. Okay, let's have a look at the value line of Nike. Can you please put plus that you can see numbers fine and you can read them? Okay, great. Now that we can see straight away, like the trend. Starting from 2003, we can see the graphs, but we definitely can see that the share price was growing all the time until end of last year. And from the end of last year, it's moved down. So the highest price was $78, and now it's 50. So it's practically $18 drop down in price. So quite a lot, about 25-30% probably if you calculate it. Now, what we can expect here, let's have a look what happened with Nike. Why did it go down? Did it lose in sales or did it lose in profit? What happened with it? Now, that's the first line. It's the growth in sales per share. And let's have a look. It's $4.70, $4.42, $4.65, $5, $5.82. And we can see that it was growing every year, even though sales level in 2008 and 2009 it was growing, and only in 2010 it had a slight drop. It's practically was flat, 987 and 982, and then it continued its growth, and it grew in 2016 as well, and it's planning to grow in 2017 and in 2019 to 21. So the company always growing, and it's even growing in sales when the economy is a really bad situation. Okay, in 2000 and 2001 it was growing again also. So that's one thing. We always look at earnings. For us, earnings more important than sales. Let's have a look what they have here: 26, 27, 31. So in 2000 they were growing as well. If we come to the until less level, also was growing here: 72, 86, 88, 97. So even it had a flat year of sales growth, but still it was profit growing per share, which is really good for us. Okay, and then it's kept growing until now. So it's growing until now, and then they're expecting to have $3.60 profit during next 3 to 5 years. Now, the dividends as well, we can see that dividends constantly increasing, and they every year they have increasing dividends, which is pretty good. They're not that big, they're only 1.2%, but still, like if you're long-term investors, one not to buy it. Now, the price earning ratio right now we can see 22. And the price is about $51 right now. And but if we have a look at the price earning ratio average, we can see that it was like 24, 24, 27 within the last 3 years. Before what it was, the lowest was about 15 in 2009, right? And then 16, 18, 20, and it was growing until 24, 27. So then we're going to calculate it using TACN table spreadsheet. We will see that the average is about 22. So at the moment it's at average level. Okay, and that's what if you take it into account all years long. So that's pretty good for us. It means that that's why actually why the price was dropping down. So earnings didn't go down, but the multiples of, like, when companies shares are sold in the market, they're sold in multiples to its earnings. And we can see that if last year or even this year it was selling at 27 times of its earnings, now it's selling only at like 22. So it's 5 points less. It means about 20% drop, okay, for us, just because people decided not to pay that that big amount of money for shares. Okay, and that's what we can see from that perspective. Another thing that we can see that value line expects the growth about in total in 3 to 5 years to 65 to $80. So in between those numbers. So it represents 8 to 13% growth every year. Now, if you remember, we analyzed company which called Hershey, It's a chocolate company. When I see Nike, I see kind of they're very similar. So they're huge companies, they're big companies, they're very well known, they're stable, they're growth stable, and customers, investors like those companies, and they're happy to pay a bit higher price than for similar for companies in the same industry. We're going to look at the Skechers, and you will see the difference. Now, remember this price earning ratio, so it's 22, okay? And remember the earnings at the moment $2.16, right? And we'll compare then with Skechers, and we'll see what kind of the difference between them. Okay, that's first part of it. Let's have a look at second part of their report. We can see that sales per company, it was growing in similar way as per share, and net profit in a similar way was growing every year. So it wasn't just even company constantly buying some shares from the market. We can see that the company was growing in sales and in earnings, not only because they buy shares from the market, because it's organic growth of the company itself. Now, the net profit margin, we can see that in recent years, it's improved. Okay, it's 11.6. 4 years ago, it was 9.7%. So now they have higher margin, which is good for us. Return on share equity, so it's on your capital, like as a shareholder, it's 30%. It's pretty good, right? If you take into account leverage and debt, which company is using on total capital, it's 26%. It's still pretty good. Okay, Warren Buffett trying to find companies with a return on share equity above 15. So here we can see it's pretty high rate of return. And that's actually the good thing. Let's have a look. And I am going to show you. You can see that debt level, the long-term debt. We can see that, let's say 10 years ago, it was 400 million. Then it was going down, and then it was increased to 1.2 billion. And then it kind of, they were paying it off. And look at this, last year, they borrowed another $1 billion. And some people straight away asking, is it good or bad thing when company is borrowing money? Now, the answer would be what they are going to do with this money. It's first. Secondly, what's the return on that investment? So if company decided to borrow, and you know that in United States, their level of interest now it's so low that they pay practically nothing there, okay, as an interest. And then you can see that if they take this $1 billion and they invest, you can see that return on their share equity, so on their own capital, and return on total capital, so it's including borrowing stuff, it's 26%. So now you always have to think, okay, what do I need to do? Give money back to the bank if I have cash, okay, and save 1% or 2% interest, which I'm going to pay, or reinvest this money in my business and get 26% return on my capital. So what would you prefer? Okay, and of course, if you see that a rate of, for example, interest rate was high, 10%, and you can see the rate of return is less than 10%, so it means it's much better to give money to the bank and pay off the debt, because when you invest, right, so you don't get same type of return as you're paying to the bank. So you have to be careful in this particular case. So in this case, we can see that perfect situation, that company is borrowing money, but they are using this money pretty well. Okay, that's one thing. Secondly, when you compare the size of the debt and capitalization, and you can see that it's 2 billion debt, and total market capitalization of the company, it's about 86 billion. So it's really low. It's about what, maybe 3%, something like that. So and so it's not that huge debt for the company. Another thing which I always look, it's what kind of profit they make. And if we see that net profit annually 3.76 billion, 3.7 billion, so it means that these 2 billions they can pay off within what, about 7 months, right? If they decide to pay off that debt, so they can make this money within 7 months. Now that's based on different kind of view on our debt. Another good thing about this company, if you look at current position, current assets and current liabilities, that's what we can see. We can see that current assets like is going down. So it was 15.9 billion in 2015, and then in the beginning of 2016 it was 15 billion, and now it's 14.5 billion. But also we can see that liabilities are going down as well, and we can see it was 6.3 billion, now it's 5.3 billion. Okay, and it stays 5.3 billion. So when you deduct from current assets, current liabilities, you get kind of a cash which company can generate within short period of time, and it's about 10, okay, maybe $9 billion. So it means that company has huge amount of money available for it. And even if they decided to pay off this $2 billion in debt, they're like, I mean, this $2 billion in debt, they quite easily can do that because there is no problem with cash in this particular company. So it's really, really good point when we analyze the company like that. So the next thing what we are going to have a look here is growth rate. And growth rate, not the price growth, but the earnings and the sales level. And we can see that sales level, if we take 10 years, in general, like in average, every year it was growing 10%, 10.5. For the last 5 years, it was growing 11.5. So the speed of growth increased within the last 5 years. And they are planning to have its 13% growth in sales. Now, if we go to earnings, we can see it's 12.5% average within last 10 years, 13.5% within last 5 years, and they're planning to have 18.5. So we can see that the speed of growth it increased within last 5 years, and they are planning to increase it in the future. Okay. Now, here I always ask how reliable these numbers, the future numbers. Can I rely on the company, on their promises? And in order to do that, you always go to value line bottom part on the right corner, bottom corner. And you can see here, earnings predictability, 100%, which is practically unbelievable. It's so great. Like, I mean, it means that every time when company notify shareholders that they're planning to make this amount of money, they're making this amount of money. So it's like they're always right. So 100%. Then we'll compare with Skechers. You will see the huge difference between Skechers and Nike. Okay, so that's a good thing. And then price growth persistence, we can see it's 100%. Stock price stability 85%, and company financial strength it's A++. So it's pretty good thing about that. Now, also, I wanted to show you one interesting thing, which is actually common for quite a lot of companies. Let's have a look at earnings per share, okay? And we can see that these 4 quarters. Can you let me know which quarter is always worse, kind of? You can see that November quarter, right? So it was 32 and then 29 and then growth. 43, then 30 and then again growth. Then 54, then 37, then again growth. You can see every time on the second quarter there is a drop in their financial year. So it's November. So it means that the next, it's exactly right now, like they're ending up their year in November, and I think they're having their report somewhere in January. We're going to have a look at this a bit later. It means that they're going to show worse results than they had here. So they had 73 cents, most likely they're going to have 44. Even though it's easily seen, you know, and everyone can see this type of pattern, the funny thing that a lot of investors who, for example, saw 49 cents here, then they saw 73, they bought it here because they saw this growth and they say, oh my goodness, look at this company, how it's growing pretty well. So they are buying here. And the next quarter, they see it's practically like went down about 30% in earnings. They're scared. They think that something wrong with the company and they start selling it. Okay, a lot of people do it because they look only between this quarter and this quarter. quarter. That's it. Okay, and they sell it. And I haven't analyzed the price movements, but when you see something like that, of course you can pick up the company at a better price level if you see that after kind of bad quarter, right, the price can go down. So and you can pick up your company if you follow it for long period, and if you're buying for a long time as well. Okay, and also we can see that they increase about 2 cents each quarter, like 2 cents a quarter of dividends for every year. So it was 12, 14, 16. So it's pretty good company from that point of view. Here you can read it, and you learn that Nike had some kind of challenges, of course, with like in general in this industry. But the good thing here, it's written that they're introducing joint venture with Apple, and they're going to sell not only shoes, but also they're going to sell Apple, I understand, fitness trackers, so similar to Fitbit, which we discussed at the last club meeting. And as you can see, it kind of creates additional opportunities and additional stream of revenue. Now, Nike, they are selling product not only in shops, they have 369 domestic and about 683 international locations. Now, another good point about when you look something like that, Swoosh LLC owns 78% of Class A shares, which is absolutely fantastic. It means that if you see such a huge shareholder in one company, it tells us really good. Now, Jan, you told about Nike finally getting soccer shoes right. Okay, that's a good thing. Okay, as well. I don't really follow shoes. I actually didn't know what kind of runners I have. I didn't pay attention when I was buying. I was choosing by design. So that's why I probably expressed my opinion that I'm not really kind of brand aware. So I can buy shoes which I like, and I checked, I have Puma actually, not Nike. Okay, so what do you think about the company in general based on that? Fundamentally, do you think it's strong company or weak company? How do you like it? Yeah, really strong company, right? Looks really good. Now remember, we never buy company just because it looks good, and but definitely we can see that there is a quality behind that company, even just looking at value line without putting it in the table. So I've put numbers in a table, and it came up 41. Now it is always important to understand where the company is losing, at what points it's losing. We can see it got industry rank, it got only 2 points. Okay, it could get 4, it got 2, so it's lost here 2 points, right? Then timeliness, it's got 1, so it's got a minimum kind of timeliness rank for this particular company, which is also put it down the price. And despite that, it still has a quality score. Like the best, and for me the most important kind of points which I have to consider, that's growth trend and the management. That's what, of course, that I pay attention to that as well. But in this particular trend was fantastic. Company always growing. Yeah, so Dean is making a point that low dividend but capital growth potential. Actually, when you think about what company has to do with their profits, and imagine that they can pay, if you made $100, okay, let's make $1 million. The company made $1 million profit. So they have 3 choices what they can do. First, they can give it all to shareholders as dividends. Now, if you get $1 million, what are you going to do? You can spend it at once, so you wasted all your wealth, or you can reinvest it. That's one thing what you can do. Second, what company can do? Company can pay off the debt which they have. Okay, and then to increase the equity part in your business by selling it. And the third way, they can reinvest this $1 million in something new, in new project. right? And as a shareholder, because you owner of this company, you have to think all the time, okay, what actions will create the highest value for me in the future? Now, if the company's like rate of return on your capital employed is, let's say, zero, okay, company, whatever they invest, it doesn't give any income. For example, they have a lot of cash laying around, doesn't produce any growth at all. Now, in this case, maybe it is better to pay off the debt because you pay into the banks maybe 1-2%, and it's not good, right? So it's better to pay off the debt. But if you pay it as dividends and then reinvest, and you might get from reinvestment point of view 10% return. So maybe it has to be paid as dividends, and then you reinvest it. So you always, as a shareholder, have to consider which is the best. And we saw that rate of return in Nike is like on capital employed is 30% and 26 including debt, so which is pretty fantastic. And that's why even if they don't pay dividends at all and reinvest it back in the company, until they sustain this growth rate, that would be fine with me. Okay, and we actually didn't look at book value, but let's have a look at book value growth. We can see that book value was growing all the time also, and it's keep growing, so which is good, right, for us. But the difference book value and the price, it's actually huge, right? So it's about 9 times, maybe 8 times, 6 you, yeah, so about 8 times difference. So it's quite a lot. No, so it means that if the company is going to get like into bankruptcy, we're going to get on the sale of assets only $6. Okay, but still we get 4 points for quality. When I put numbers in price, so that's what I saw. Now that's the highest levels within last 5 years. So it was $28, $40, $49, $68, $65, and then I put lowest levels, and then I put earnings during those 5 years. So and then come up with average high, average low, and then average earnings. And when you divide average high by average earnings, you get average price earning ratio at the highest level. Okay, and that was 31. So it means that during those 5 years, at the highest level, and in few times during these 5 years, the company was like selling it, not the company, shares were sold at 31 times multiples to its earnings. So if the company was making $1, it means that the share price would be 31.42. Now, and at lowest level, we can see it was 22.19. That was the lowest level of their price earning ratio at low. So it means that sometimes it moves from 22 to 31 within next. And now if you remember, what's the price earning ratio now? It's about 22, right? So that's what 22.7. So it's actually just at the lowest point. So even if company keeps the same type of earnings, right, it might go to this multiples because that's what it did before. So, and it means that it's going to grow about what, nearly 30% here, 40% on that only like statistical data. Now, if we take into account, okay, they're promising they're going to make $3.6 within the next 3 to 5 years. And then we assume that sometimes in the future they're going to reach that point, okay, and that multiple. So when we multiply, it means that sometimes in the future we can expect that Nike is going to be at $130. Now, if we take the worst case scenario and we keep the same earnings and we assume, okay, what happens if the company keeps the lowest level of multiples, which is 22, and keep making like money which last year, $2. So it means that the lows would be about $47. And then we break it to 3 parts, and that's how we get this gap. So until $69, we might buy this company until after 69 we hold this company, and above $91 we consider to sell this company. Okay, because at the moment the highest chance that it's going to go up, right? At those levels we will have higher chance that it's going to go down. Now current price is $50, so it means that from $50 to the $47 we have a risk of going down $3. Of course, it can go lower, but based on our statistical data for the last 5 years, we can assume that that's where there's strong support level in this particular case, right? So we can see that it can go about $2-3 down, but at the same time, we have a potential of going up about $63. So we have risk to reward ratio is 30 times. So we have 30 times higher potential for growth rather than to fall. So, and that's a really, really good thing for us. Ian wrote, looks like it ticks all the boxes plus easily understand. There, it's easily company. That's why I decided to have a look at this company. Now, if we look here, all points, it's losing estimated price appreciation. Okay, and because they have price appreciation value line, what they consider is 13% only growth, right? So that's where the company lost points. But despite that, on all other points, they have very good results, and they get the maximum score. Okay, that's why we have 40 true by price, and that's the highest score. I mean, it's above 40, so it means it's quality, it's undervalued company right now. So based on TSN guidance. Okay.